So the stock market is finally starting to bounce after the sell-off. We had a bounce, earlier in the month, but it did fail. So are we going to actually get this bounce? Or are we going to stick in this bounce? Let's dive into the technicals first, right? What are the macro forces signaling reversal? From my understanding, from my research, the way I'm looking at things, I think we're getting a short-term bounce. Can it last? I don't know. We don't know. Like, can it last? We're going to have to keep up to date with that. But for the most part, on a technical basis, let's look into the support and resistance levels, right? So this is S&P 500 SPY, right? The 4,400 level was violated, got rejected. Previous level got violated, right? Came into the 438 level, got violated, went lower. And we never reached the 431 level, which we could still reach in the future. We could still come back to this if we get another surprise. But there's no surprises, right? There's not really any surprises. So what we did signal in the newsletter, if you are keeping track of that, right, is that the S&P, right, these are the technicals, are holding the uptrend. We're still in the uptrend. We're approaching oversold territory. So we're looking at a reversal coming in here. And we finally got that reversal. We're still holding the uptrend every single time we get, well, not every time, but for the most part, 90% of the time, when you become oversold, you get that bounce. So that's what we got. We got the bounce today. Now, the good part is we're back above the 438 support level, right? We're back above that. You can see the RSI is starting to turn up. It got down to about 35, and it's coming back down, right? So is there still room for the RSI to move lower? 100%. Yes, we can still move lower in the RSI, but you never know. Maybe we'll get some upside, right? Now, the downside here is, well, take a look at the Qs. The Qs also bounced right off the trend line, okay? So the Qs are coming in right on the trend, right against the trend that I've drawn from the lows. This is the trend from the lows, right? And we're coming in right on the RSI also got pretty low. You're getting a reversal signal here. We're coming off the trend. We can still consolidate around these levels. It still needs to get above 364, 365. There's definitely some interest coming into big tech because it's already sold off so much, right? You got Tesla selling off extremely to the downside, down 25% on average. Tesla's starting to bounce. I think Nvidia also had a bounce. So we said, hey, Tesla's low is around 221, 220 to 230 to 221. It went even lower, capitulated even lower, but that was a reversal signal. Now it's still not out of the downtrend, but it is bouncing. Okay, so back to the overall market. What are the big risks that we're seeing here before we go over the reversal signals, right? What are the big risks to the market? We'll go over policy, the economy, kind of what we're seeing here. Well, 10-year US Treasury yields, or the bond market, is still going higher. So long-term rates, which affect mortgages, demand, right, for housing, which affect long duration risk assets like technology, are still going to be threatened by these rates going higher because long duration assets are valued off of longer term rates, right? Point blank. That's a 10-year. You go to the 30-year, right? 30-year mortgages breaking out to what is it? This is breaking out to like 10-year highs, I believe, or maybe even more than that, 20-year highs. So that's not good. That's not good for now. This is probably the worst thing when the yield curve starts to steepen back up to normal territory. This is what you don't want. Okay, the only good thing we have here when it comes to rates, when it comes to interest rates outside of the Fed, right, the bond market rates, the only positive here is that short-term rates are still at resistance. So short rates, which are going to affect the economy more, are still finding a resistance. They're still not breaking out. So that's good, right? And that's because there's a lot of demand for short-term rates. You're yielding 5% on 3-month. I should have had it up there on 3 months. So that's good news, right? So the 5-year, here we go, the 2-year, right? They're not breaking out. It's just long-term rates. So long duration assets are going to have an issue. Mortgages are going to have an issue at this point, right? Now, banks, regional banks, which we will get to. So let's scroll down a little bit to the regional banks. We're looking at the market internals here. Okay. Looking at the technicals, the market internals. So regional banks, KRE, they're going to have some risk. They've been selling off. Why? Because they hold a lot of US treasuries on the long end. So if the US treasury yield's going up, you must tell yourself, or you got to realize that means the bonds or the collateral that the banks hold is going down. If the collateral falls enough, they might have some default risk. Okay. Do we know where that is? No, but the market is pricing in that actually happening. Also XLF, which is the financials, are also selling off, but they might actually be in a trend. Okay. Now the reversals, right? The reversal macro forces that I'm looking at, the reversal forces that I think are going to take this market higher, or at least sustain the bounce for now. Okay, outside the economy, we know it's strong. Outside inflation, we know it's coming lower. Outside of oil prices falling, we know that's a big positive. You have the dollar, the big macro signal. The dollar is the wrecking ball to the markets, to the crypto market, to the stock market. If the dollar breaks out, it is an inverse correlation. We're in trouble. But right now, the dollar is finding resistance. Okay, it is finding resistance against the trend. And we talked about this, right? The RSI is oversold. Okay, we're an overbought RSI. So the RSI is overbought. You get resistance when the RSI aligns, right? We talked about this in the newsletter. Go subscribe if you haven't already subscribed. This is actually our third signal right here. So reversal territory, right? We're getting the dollar, and the subscription is free. Go check it out, okay? You're getting this reversal because the dollar's pulling into the downtrend. Okay, it's finding resistance here. Can it break out? Sure, it'd be nasty. If it does break out, we're in trouble. But for the probability lies that the dollar starts to roll over a little bit, right? And there's two scenarios that the dollar moves higher. One's good, one's bad. It might move higher because China, other central banks start debasing their currencies. If they weaken their currencies against the dollar will rise. Okay, it'll still hurt, but it's not a bearish signal. The bearish signal is that rates keep going up. That makes the dollar more valuable because you're getting higher yield off the dollar because rates are higher. So if you park your dollars at the Fed, you park your dollars in a money market fund, you're going to yield 5.5%. A lot of people like that. A lot of investors, a lot of professionals, institutions are going to want to get that risk-free dollar yield out of the stock market, out of the crypto market. Rates go higher. Okay, so for the most part, the dollar is starting to reverse. And and we're getting bearish divergence, right? You're getting bearish divergence, which means technically the dollar should move lower. Hopefully that is the case for you bulls. If you're a bear, you want to see this breakout. If you're looking for a bigger long-term pullback or a bigger correction, then that correction will come with the dollar moving higher for the most part, a giant correction. If not, it's not going to happen. Okay, short-term rates, right? Going back to short-term rates are not moving. This is good. This is good. They're finding resistance there. They are sticking a little higher. Now, the positive here is that people are yielding off these short-term rates. When rates are elevated, right? The 2-year, the 5-year, the 10-year, the 30-year yield. What you're also getting is if you're parked in treasuries, you're getting a yield, right? This is going to attract debt buyers who want to buy government debt. This will attract them because the yield on it or the interest income on it is rising. So I think, I think there's a scenario where these do start to slow down, but if they speed up, definitely in trouble for riskier assets. Okay, so TLT, the bond market, right? The bond market is at the lows. The bond market has been crashing lately. Now it's back to the October 2022 low, right? It is back to the October. Here's the difference, though. The difference is back here, inflation was going up, right? Or inflation at least had peaked. So inflation was somewhere around, it was somewhere around like 7-8%. That was a terrible 7, but it's somewhere around 7-8%. Here, inflation is at 3. So it's not the same market, right? The only reason that bonds are selling off traditionally or in general is because the economy is moving up. So you got a strong economy, and people say, well, if the economy is not falling apart, why buy protection against a weak economy, right? Why buy protection against a weak economy if it's going higher? Matter of fact, we should buy stocks, and I think that's what we're going to see here. Before, interest rates were going up and the economy was, inflation was up, and at the same time, the economy was weakening. So we're not getting that scenario. Bonds can bounce here, but it's all going to come down to inflation. And that brings us to the next charts, which is the chart of oil, right? The most important inflation. I think this is the most important chart in the market, bar none, not even close. I'm just kidding. There's other charts, but this is my most important macro chart because it is the biggest input to inflation, because if it does move higher, then if it gets above the big level, the 8350 level, then inflation expectations rise. The Fed, the Fed increases rates or starts to change their language a little more hawkish, which means, okay, we're going to tighten the economy. Inflation's coming right back up, right? And so far, we're not seeing that. So back the last reading of CPI was higher because simply crude oil went higher. Okay, today it is sideways. So if we stay sideways from the beginning of the month, right? This is a measurement of the month. CPI is going. The September CPI will measure the August inflation. And August inflation is going to be anchored to oil prices. And oil prices have been flat thus far. If they remain flat thus far, that's a zero inflation rate when it comes to oil prices or energy in general, which means the CPI is going to come down. I think we get into the 2.9s. The market is expecting, I think, 3 flat, and that's going to be a positive scenario. We have Jackson Hole this Friday, which means, this is the big Fed meeting, and we're going to get a little more commentary. And if the Fed is nearing the end of their tightening cycle, if the Fed is nearing, right, are starting to talk about cutting rates in 2024, what is their outlook on the economy? This is the most important Fed meeting. It sold the market off back in 2021 when they said we're going to start increasing rates tremendously. In 2022, they said, hey, we're going to keep increasing rates. The inflation is not over. Maybe we're at the end. Maybe the Jackson Hole meeting, Powell can announce, hey, we're close to the end. Maybe his commentary is a little more dovish versus, hawkish. I think that's a possibility. Excuse me, my nose itches bad. Woo. All right, so back to it, right? That's what we're looking at. Now let's look at the rest of commodities. Natural gas is down. No energy inflation, okay? Copper, still weak. It is bouncing. That looks like a trade there. I like that trend for copper, but copper's still low, right? And the Chinese economy is not recovering as fast as we thought. So there is no commodity inflation. Where's inflation coming from? Nowhere. If anything, it's shelter, which is very lagging, okay? Going over to wheat, is there going to be food inflation? No. Wheat, double top up here at, it doesn't matter. It's a double top right into that previous support line. And so even wheat, right, a big input to food, a big input to cattle or whatever else, any kind of feed, wheat prices lower. We're Americans like high carbs. It's a high carb world, and it should be high protein. But for the most part, you're going to feed your protein with wheat or corn or whatever, and those prices are coming down. Now, the put to call ratio is something that we were looking at also in the newsletter, put to call ratio. Let's go down to what we're seeing here, right? And we called this yesterday or on Saturday. We said, you know what, the market should bounce, right? Does it reverse back up? I don't know, but we should get a bounce because the put to call ratio, which is basically more, if it goes up, there's a lot of puts coming into the market. All right. And we're getting back to the March 2023 levels when we had SVB, the Silicon Valley banking crisis, right? Or the banking crisis in general, the regional banking crisis. That's when the puts went up. But once you get to that high level and the market is pulling back, so let's go to the S&P, right? When you get the market pull back, guess what? Those traders that are selling the market are basically buying puts against the market. They're going to cover because they just had a nice, who knows where they entered, but they just had a nice trade, right? 2.5% from the last previous level, from the highs, S&P anyways, you're looking at 5.5% pullback. So they're covering their positions, and usually that is the bottom. That marks the bottom. As you can see here, last time the put to call ratio peaked, you got the bottom of the S&P. You got the bottom of the S&P 500. Back here, it was a little more delay, but you got the bottom. So does this mean today or this week is the bottom? No, it just means we're near the end of the sell-off. We're starting to find a bottom here technically, but you do need the S&P to materially hold the next level. So maybe we don't, right? But 438, we're looking back at 438. Can it hold that level? Right? 438 was the previous support zone. Now we might be able to call that 435 since we got a couple capitulations against that level, especially today. And we'll look deeper into those technicals, but for now, that's sort of what we are looking at, okay? Now, a little more market internals. Also, there's a couple indexes that are showing that U.S. ETF flows, short flow just hit a peak, right? So we just got short flow also hit a peak. Now, what else were we looking at as far as this? Oh, the VIX. Yeah, we didn't even go over the VIX. So look, the put to call ratio is starting to peak out. When we move over to volatility, okay, so we're going to move over to the VIX, which is a insurance against the S&P 500. So the VIX is usually insurance. The VIX is finding resistance against the previous zone. So the VIX is not materially spiking over the last 2 days. It's actually bearish because, that was the end of a technical move. These are traders that have traded the short side, and now they're collecting profits. And now it's going to come down to, can the bulls take control? Can the bulls step back in and hold this market up, right? If the VIX keeps going higher, that's going to be a negative signal, especially if it gets above the previous resistance levels, right? 21 is terrible. Once you get into the 20s, the VIX becomes, volatility really starts to come up, and the VIX becomes a real threat to the market as far as instability, right? So under 20, we're in good shape. Once you get below, 15, basically you're in a bull market, and we were there. But, I think mostly this pullback in the S&P and the Qs is due to rising bond yields, right? At the far end, rising rates on the long end, and at the same time, collecting profits. The Qs, the technology stocks were just up way too much, right? So we're back to normalization, okay? Now, volatility on the Nasdaq is coming down. It's not really making a, sharp. Could this move higher? Sure, but it's not exploding at the moment. Bond volatility, still pretty low. Now, it's still elevated, over the last cycle. This is still elevated bond volatility because the bond market is a little shaky, but it's not spiking immediately. When we get that spike, that's going to be a big risk off signal. You could get further banking risks, right? Bond volatility, but triple B spreads on the rise. So credit risks are still rising. We got to keep our eyes on that. That's not good. Now equity credit starting to roll over a bit, but I want to really take our eyes over to the market internals. Okay. When I say market internals, I'm talking about the equal weighted average. So this is Nasdaq equal weight. What do we see here? We're seeing that Nasdaq equal weight, right, that is right on target. It's right on the trend. We're just bouncing off the trend, right? And the reason why equal weight is important because it gives you market breadth, something called market breadth, however you want to say it, right? And what that means is you're getting more stocks participate. Okay, this is a reflection of how many stocks are actually participating, not just the Magnificent Seven, not just Apple, Amazon, Google, Facebook, Tesla, Nvidia, AMD, you could throw in there, whatever. It's all stocks are starting to bounce here at the, that level. The Dow, right? The Dow is a reflection of more of the value stocks, right? And the Dow should remain strong with lower rates, with short-term rates remaining low. Long-term rates don't affect the Dow as much. They do, but not as much. So we should see the Dow, bounce here at the support line. Moving over to the small caps, right? Small caps really barfed here. We got a real barf in the small caps, but they're still on trend. They're still trending up. I actually got to pull up the IWM equal weight. Eventually, I haven't even thought about that, but we got to do that. So here's S&P equal weight, right? S&P 500 equal weight, maybe the most important index for looking at participation in the overall market. The top 500 companies equal weighted out. You're getting a bounce on that trend. Okay, so we are seeing that trend bounce. Over to crypto really quick. Bitcoin at the big level. So Bitcoin is pulling into the 25K level. This has been a historic resistance turning into support, right? And the RSI got down to 19, right? We haven't seen a 19 RSI. I mean, you got close to it back in June. You got close to it back in what was this, January of 2022. But this is really the steepest daily RSI pullback since March of 2020. So if we go even further, right? If we do happen to sell off even further, then that is a signal to buy Bitcoin. If you're underweight, if you're overweight, this hurts. If you're overweight, you're going to get scared to sell, but underweight, investors, underweight institutions are licking their chops especially with the ETF coming out at some point, right? You got to believe that at some point the ETF will come out, whether it's 2023, 2024, people are going to position themselves long Bitcoin, okay? Ethereum, same thing. It's leaking pretty low. The RSI got pretty low back to the levels back in June of 2022 where it got down 800. Some people are calling for Ethereum to drop in the hundreds, right below 1,000. I doubt it, but that's what we're looking at, okay? All right, so next, going down to the actual internals of the market as far as what sectors are moving today. We're going to get into the days, into the intraday price action, but let's look at what sectors are moving today. So today, starting with the financials. Okay, so starting with the financials, you do have this hammer candle. Okay, it's still red. It started off kind of negative, but the banks are starting to move up a little bit. And they really need long-term rates to come down. The Treasury market, the bond market is putting pressure on the banking system because Treasuries are the collateral. It's like cash. And if your collateral keeps falling, you might be in trouble. Okay, so now next to the regional banks, going to the regional banks. Regional banks, pretty weak today, a lot more weak than the financials overall. Okay, going over to energy, inflation. Energy slowing down. Oh, I wonder why, because we're getting oil start to slow down. Okay, XOP. This is oil and gas products. Okay, this might be actually a good hedge if inflation breaks out. This could be a good hedge. XOP, I'm not really interested. Okay, solar, getting smashed. This is why ENPH is so low. Look at the RSI though. The The RSI for solar is so low. I think what really pulls this higher is going to be the White House or maybe global policy, global fiscal policy coming back in and saying, okay, we're going to have to reinvest in renewable energy, right? And maybe get some more bills passed or some more optimism about transitioning over to solar. But so far, this thing TAN or the solar ETF is getting smashed. Okay, you go over to clean energy, also maybe finding a bottom here, right? The RSI is pretty low. They may be finding a bottom, but it's been pretty weak. It peaked back in February of 2021. So this is more of a risky ETF, and not risky, but it's more of a long duration ETF because it's renewable energy, right? And we just haven't transitioned yet. But if you're looking for a low, pretty good low, it's about what, 200, 300% to the highs. It's a very explosive ETF for clean energy, right? And more so, we're tracking it as in what is the sentiment around, liquidity coming into the sector, or the overall economy, holding up clean energy, and it's just not there at the moment. Tech is pulling back, right? We already looked at the Nasdaq. This is tech. We looked at the Nasdaq. It looks like it's double bottoming there though. And then we have these semiconductor ETFs, right? SMH is going to be the semiconductor ETF. I think it's now pulling into the trend, and a lot of people are going to be interested. We do have NVIDIA earnings coming up this week, so that's going to be a big catalyst to the market in general. Just looking at earnings going forward, what is the demand for chips? What is the demand for chips, and how is government stimulus factoring itself out into these earnings calls, into the revenue? What does it look like going forward versus these high rates? Okay, communication services starting to bounce here. Industrials kind of weak. Healthcare is something that I think is looking pretty well. It's been underperforming for a while. Now the biotech ETFs they're still pretty low. So anything in the healthcare sector still hasn't moved. You have opportunity here, and I think my two favorite opportunities, along with connecting to these ETFs. So if you're looking at XLV Healthcare, I like Teladoc, right? And then if you're looking at biotech, I like CRISPR, but CRISPR is a very risky name in general. CRISPR Technologies, right? XLY, consumer discretionary, starting to bounce a little bit, right? So and remember, the consumers are running this economy at the time. 70% of the economy is consumer spending, and we know GDP, jumping over to GDP, it is grinding up. GDP has been grinding up mostly from consumer spending, and this is GDP estimates. Okay, so this is the expectation versus you're looking at the monthly data, and then you're forecasting, okay, what should GDP be if this keeps up, if consumers keep spending, if credit continues to expand. Okay, so that's sort of what we're looking at there. So consumer discretionary should get a bounce here if that is true, but these are just the ETFs tracking it. Okay, consumer staples, so more defensive stocks, still pretty negative. How about retailers, right? Retailers, they're sideways. They've been sideways for a while. No big jump in retailer, but that could change if we do get a pause. That could change if we get more fiscal policy. The student loan repayments is going to be negative for retailers because you get a portion of the income, focused more on paying that debt. Now, maybe people won't pay debt and it'll just continue. Well, who knows? All right. Utilities falling like a rock, probably because energy and inflation is falling, so that factors in there. So that's pretty much that piece, right? That is pretty much the piece that we're looking at there. And the other part, the whole other part is, when will the Fed actually reverse? Right? When will the Fed reverse? So keep in mind, the VIX is showing a bearish divergence. Okay, the VIX is showing a bearish divergence. This might be the top of the VIX, insurance against the S&P 500. The dollar starting to show some divergence or reversal territory, reversing. We look over the 30-year yields. Well, we thought it was going to reverse, but it's still moving higher. That's something we got to keep our eye on. S&P is starting to bounce finally, and the put to call ratio is pulling back. So one thing to focus on when it comes to the put to call ratio is, you got to put this in a line chart also, is that if it trends lower, that was probably the bottom. That means a lot of the shorts on a technical basis are getting out of their positions. Okay. And that can definitely be something that, a technical catalyst or positioning catalyst that can get the market to hold these levels until Jackson Hole, or until the Fed starts to speak on the market, what it thinks about the macroeconomics, right? But if we do bounce on the put to call ratio, that means the puts are coming right back in. I still think you need fear to do that. My guess is to finish this week off, just so you know, my guess is S&P does bounce at these levels, right? It does hold up. And then Friday, going into Jackson Hole, going into the Fed's most important meeting, is going to determine, well, actually going into that, I think we might sell off. So you get the buy the rumor, which is, okay, things aren't too bad, right? Or the shorts are covering. So you get that buy, and then maybe you sell off into 442, 444. You get a rejection here. We're not going to go straight up. There's nothing, there's no news, there's no catalysts that take us much higher from here, right? There is really no catalyst. So I think we do kind of consolidate between these levels. If we can hold 438, maybe between 444 and 438, okay? Now, going into, like I said, going into Friday, maybe we get a sell-off on Thursday, and then we wait and see to see how the market digests it. So I think we're going to be sideways for the end for the rest of this week. We could rally sharply. We did also get Sunday some news that China is cutting rates, okay? So that's good for global liquidity because currently global liquidity is pretty terrible. And let me give you a quick view on that if you are on the YouTube so you can see what I'm talking about. Global liquidity, here we go. So this is the Twitter anyways. You got the S&P 500, right? And it basically kind of moves with liquidity. Liquidity is a big factor. Fed balance sheet has been selling off ever since March. So that's dragging down liquidity, which fuels capital markets in general. Global liquidity, if you add up the Bank of China, the Bank of Japan, the US Fed, the ECB, the European Central Bank, and the UK. What is the European Central Bank? I think it's the European. There's another bank. It's in Europe. I think is it German? I don't know. Either way, you add up all the liquidity coming from those banks' balance sheets, and they're starting to roll over also. This is Fed net liquidity, so minus the TGA. This is just confusing. Either way, you just look at the liquidity and say, okay, what is it looking like? Liquidity is pretty flat. And then the RRP liquidity, which is money market fund money leaving the money market fund, coming back into the market, whether it's to treasuries, whether it's to stocks, or, those are real estate. But I think that RRP money is also slowing down according to the chart. So liquidity kind of sucks right now, right? Liquidity sucks right now. That is an issue. We're keeping track of liquidity to see if that changes. Now, here's the positive, right? The positive here is that China, as far as markets, not economies, China it cut their 1 year rate. And this is the second time that they've cut rates in 5 days. They cut rates last week, their 1 year rate. So their short-term rates, they're starting to cut. That brings down their short-term rates where ours are still pretty elevated, right? And what that does is it unleashes a little bit of liquidity and an interest in investment into China. So we got to keep track of their macro data to see if it actually holds up their economy, but that is what we're seeing. Now, Ryan Dietrich posted, okay, just looking at stock earnings right now, because we know GDP is up, and GDP should, initially flow into earnings for the next earnings season. So I think the market is finding a bottom here. And what he says is stocks are pulling back in a seasonally weak period, right? Seasonal weakness, August to September is the weakest months. And now that this is on everyone's radar, now it's on everyone's radar that the market is seasonally weak in September. What does that tell you? They're going to stop selling. They're going to wait for the bottom. And I think the bottom comes in before the end of September, right? So what do you say? Normal behavior to flush out weak hands, in my opinion. Remember, we are seeing very little stress in credit markets, and forward EPS up a solid 1.8% this quarter, meaning EPS is actually, or earnings per share, which drives the market other than policy, right? Earnings per share is also up this quarter. The projections are starting to move up. I think earnings are bottoming. So this is just EPS estimates, right? They pretty much bottomed back in, you would say January of 2023 when the market really started to take off, and they've been going up ever since, right? And a lot of this contribution to earnings is coming from fiscal policy. And now what we're learning is the cash that's yielding, right? The interest yielding from cash is also reshuffling itself back into earnings. So if you're Apple and you're holding a bunch of cash and you're yielding off your cash 5%, that kind of erases the interest rates, right? You might be paying locked in. First of all, a lot of equities, we talked about this last week, a lot of equities aren't even paying interest rates. So think of it this way, right? This is a little technical talk here, but bear with me. Bear with me, right? This is basically a way to look at what's going on with the equity market as far as no credit risk. yes, the Fed funds rate is at 5.5%, but that doesn't affect equities initially because most of equity debt is already fixed, right? It already locked in a low rate. So it's not really hitting equities. Neither will it hit equities until after 2030, right? Yes, some equities, yes, they have to refinance, but for the most part, a lot of that refinancing won't have to happen until after 2030, which means the interest rates now aren't really hitting US equities, right? It is just not really hitting US equities. And we can see it here. The corporate costs of as a percentage of profits are still going lower. So profit margins are still rising against Fed funds, up to the right. Now, if you're like Apple, you hold a lot of cash and you're yielding off that cash. Just think of it this way. If you're yielding 5% off your cash, interest rates, and your interest rates are locked in at 2, you're actually making more money, right, off your cash. Or at least you're staying afloat. At least your earnings are not, falling apart. And I think that's why earnings are starting to bottom at this point. So that's a positive outlook in my view. I don't know if we have any comments here. Nope, no comments, no questions. I'm going to jump into the technicals because I know some people want to do some technicals on S&P, right? We're going to look at the technicals on S&P 500. Also talk about what is it going to take for the Fed to actually bottom here. Or I'm sorry, to pivot, because Jackson Hole is on Friday. Jackson Hole is a big meeting for the Fed. All right. And then tomorrow we get Fed Barkin speaking early in the morning. So we're going to get, sort of the Fed speak into that meeting, or not into that meeting, into the open tomorrow. We're going to get existing home sales. Here, you know what's pretty positive? New home sales are skyrocketing, right? New home sales are skyrocketing. Come on, refresh. Oh, that's supply of existing homes. Supply is starting to pick up a little bit. No, new home sales, where it's at. Where are we at? New home sales, new home sales. Here we go. So this is another testament to the economy starting to recover here. It's just new home sales on a year-over-year basis are starting to rise. So there's a lot of positives going on here. That means productivity is starting to pick up while we see inflation also fall. Okay, that means we are seeing that. So backing up a little bit, where's the inflation data? Inflation data. So it must be at the bottom. Yeah, so our previous inflation data, this is also something I'm going to be watching for when the Fed speaks, is that U.S. core inflation, if you take out shelter, is way below the Fed's target, right? You take out shelter and it's almost at zero. It is headed for zero. And what does that mean? That means the Fed can actually pause, right, when shelter falls, because if you take out shelter, it's kind of sticky. I'm sorry, it's not sticky at all. If you put in shelter, it's kind of sticky, but we know real-time rents are definitely not sticky. Okay, and these are real-time rents here falling like a rock versus the Fed CPI, which is super laggy. All right, and also if oil just keeps falling, right, and this is, we're looking at the August CPI data that's going to come out in September. If oil keeps falling, then the Fed might say, hey, you know what? We're in restrictive territory. We're restricted enough. And if CPI keeps falling, that actually puts us in more restrictive territory. We don't really want to spike the GDP to fall apart. So we're going to actually cut rates by 25 basis points in October, right? Maybe October, September, December. Sounds like a pipe dream. And it probably is, unless we get crude oil really fall apart here. Because also that means disinflation is going to impact earnings. It's going to impact the economy in general. Now, on a technical basis, the S&P is strong. On a technical basis, we're seeing a lot of strength in the S&P. And we're going to look at some more market internals here. I'm going to switch charts. If we don't have no comments, I'm going to switch charts over to TOS, which is the trading, which is more so I'm going to do I do real deep technical analysis on this one. All right, so what do we got here? Top right corner. This is this is the dollar. That's not what I'm looking for. I'm looking for S&P. Let me switch this up. S&P 500 last 50 days. 50-day moving average. So this is how many stocks. There we go. How many stocks are moving above their 50-day moving average? So check this out, right? Right now, this is a number here that or this is a signal here. We have about, I guess you could say 35%. This is pretty poor. You have 35% of stocks in the S&P 500 moving above their 50-day moving average. They all fell. Most stocks fell below that average, right? but we're extremely oversold. Extremely oversold. As a matter of fact, we haven't been this oversold since what? Let's go back a little bit. We haven't been this oversold for a while. So this is basically a sharp pullback in stocks. When you get a sharp pullback this fast, you usually get a bounce. Okay. So you usually do get a bounce. This is market internals. Okay. Not since, not since October of 2020. Are you serious? The last time we had such a sharp pullback this far? Oh no, I'm lying. Okay. We had it back in, we had it back here in, what was this? 2021. Okay, this was actually right into Jackson Hole, which is funny. This was August of 2021. So 2 years ago, we haven't had this sharp of a, market cyclicality or out of the moving averages, dropping the 50-day moving average, which is another way of saying, how would you say it? Another way of saying the expansion fell really sharply and we should bounce here because there's no real risk coming into the market that are sustainable other than higher rates. Okay. Inflation is no longer there. So I think it's a little overblown. Now we move over to how many stocks are moving above the 100. Let's check that out. The 100 moving average. And we have about 50%. Okay. About 50% of stocks are holding the 100 moving average. So the daily average too. We're looking at the daily chart. So that's pretty positive. We're at the 50% line. All right. How about that 200? A lot of people are calling for the 200 daily moving average, and it looks like we're at 50%. So half of the S&P 500 stocks are holding the 100 and the 200 daily moving averages, and only about, a third are holding the 50. So this is a real sharp pullback, although price is still elevated, right? And that's positive. Price is still elevated. So shifting over to the actual charts, and it's also talk about the intraday charts for today. See, is this going to mess up my chart if I pull it down here? Yeah, I guess it does. We'll keep it normal. All right. So, man, this is a really good bounce here. So today we had, and I'm also looking at the price action. I think people are getting FOMO for tech, right? They're seeing Nvidia, Tesla sell off extremely, Apple, and I think buyers are going to come back in the Qs. And we saw that bounce today in the Qs. We saw the bounce in the S&P 500. Advanced decline is still pretty negative, but it is coming back. IWM today, what did it look like? Back above VWAP intraday. The Dow was also back above VWAP. So we could have some more consolidation, but for the most part, you are getting that bounce. And this is the Qs. This is the technology sector here, right? Got a little oversold. Let's see. So let's do some TA. I'm going to go a little closer in here. The intraday. How strong is this bounce? I'm going to go to the 30-minute chart, right, to sort of see what are we looking at. Are we looking at any gaps to close here? 30-minute chart, and also remove this. Let's take all these, let's take all the pre-market off. So we came right into that support on the Qs. We do have a gap at 366. Actually, no, the next gap is around 370. Okay, 370 is that next gap. So let's mark that up. 370 gap. We got to fill that gap at 370. Also want to change the color of this to, let's change this to blue. There we go. All right. So we got the 370 gap to fill. Will it fill? I don't know. But what we could see is, okay, we recover into Thursday or Friday, and then we get rejected at 370, or at least we hit some resistance around 370 if the market does bounce pretty strong. Okay. So these are the Qs. Going over to NDX, it probably looks the same. Yeah, about the same thing on NDX. Go to SPY. SPY, removing the pre-market to get a cleaner picture at price action. All right, SPY has a gap at 448. That would be a strong, move higher, right? And this is all off yield risk. So yield risk is still elevated though. So yield risk is still there, at least on the long end. So we're looking at that level on the SPY 448 before you get a material reversal back to the downside. Okay. Nvidia has earnings. What are they going to look like? Nvidia is absolutely exploding, right? That's a big reason. Man, Nvidia is basically back to all-time highs. That's insane. Basically back to all-time highs. Now maybe it does sell off. It did fill the gap. It moved higher. Or maybe there's some insiders that understand, hey, you know what, the AI narrative is still strong, and who knows? Who knows? We'll see on that earnings call. There's still a lot of demand for chips. Apple was a big market mover. A lot of people say Apple needs to recover before we move up. I agree. You need the biggest stock in the market to recover. Maybe this was the bottom. If we look at RSI, I think RSI will also give us that signal. You know what? Hold on. Before we do RSI, I want to look at Tesla. Any gaps on Tesla? What is the Tesla gap? Tesla's filling a gap at 232, 233. Okay, 233 and then 239. Those are a couple gaps we got to look at for Tesla. But back to the macro chart. Okay, back to the macro chart. I wanted to look at, look at Tesla's move. So Tesla is finding support. I'm going to edit this. I'm going to turn this. Let's go yellow. Right? This is our support line. So Tesla is moving. And here's a big reason why we said, hey, Tesla's a buy. It got extremely oversold. Extremely oversold, and it bounced. It got below the 30 RSI, or another thing for saying, hey, this thing has no selling pressure. The selling pressure is extreme. And so the buyers step in. And today's all green, right? It is Monday. You know, we were due for a bounce, but that bounce, we are looking for a sustained rally. We're looking for that bounce to maintain. If you want to go bearish, well, there's a lot of resistance at 241, right? 241 looks like there's a lot of resistance there. And there's a gap to fill at 245. That's when it first started to gap down before it lost support. 242. 242 for Tesla. So we are getting that reversal on Tesla. When it does move up, when it does reverse, it's pretty strong, right? So we're now above the 100 daily moving average on Tesla. We're now, finding a bottom. The RSI is starting to move up. Maybe we consolidate. Maybe it doesn't go straight up, but it is looking pretty solid here. I want to look over at Apple too. Oh, and once we break this downtrend, then we can, let's see if I can extend this. No, I'm going to remove it. We are looking at the downtrend here also. So I think Tesla needs to get really above 240. It needs to get back above 240 for the move to really get some momentum. There's a lot of shorts, as a person who does technicals, I think there's a lot of shorts here at 240, 241. And once we squeeze above that level, Tesla should continue. Okay, let's go look at Apple. Okay, Apple also has a very clean downtrend. It looks very similar to Tesla. Apple needs to break above 175. It's above 175. It probably needs to get above 177. Let's go 178. It probably needs to hold 178 to continue. Okay, but look at the RSI on Apple. I mean, that is some pretty strong selling pressure, right? We're at the bottom. This is like a rubber band. Once you stretch it so far, the rubber band has to snap back. Now it could snap back and go lower, but you are getting the initial snap back to the upside right now. So Apple is something definitely to look at as a proxy for the overall market. Okay. Meta. Yeah, they all look pretty similar. Meta's above that 100 moving average. We got a Meta. What does AMD look like? AMD still has that really sharp. Okay, yeah, AMD is now showing a wedge pattern is probably your best bullish pattern, but if they fail, then you're looking at the next bullish pattern, which would be a flag, a descending flag. So you do have AMD forming the flag pattern. I still think AMD, when it does break out, it's going to have a lot of tremendous upside. But I'm not willing to bet on it yet. I'm more so willing to bet on Tesla because I think the catalyst pipelines are a little stronger than AMD's at the moment. But AMD is still holding that uptrend. You have all the moving averages pointing higher, right? At least on the daily. I'm sorry, the 200's pointing higher. The 50's coming down a little bit. Has a little bit of room to consolidate still. But for the most part, AMD is on a nice trend. That is a really nice trend pulling into that upside trend. And then let's take a look at Amazon. Okay, Amazon's holding the 50-day. So this is one of the only mega caps that held the 50-day moving average, right? And it's just grinding higher. Held that 50-day at 130. Amazon looks good. Google also holding. NFLX, Netflix is holding the 100. So Netflix sold off pretty sharply with Tesla. And we can actually track this trend. Okay. And we're going to look at crypto in a second. So honestly, Netflix is showing a really sharp wedge here, right? That's a really sharp wedge pattern there. I think tech is setting up to start leading again, whether it's at the end of this week or next Monday. Now, this is going to take some time. Right, the market is just starting to bounce. So it could be that tech it could be that tech doesn't bounce until next week after Jackson Hole. Okay, that could be the case. But Netflix definitely looks pretty solid for a bounce. All right, so what else are we missing here? What is Wall Street looking at? Those higher rates. Yeah, I think global liquidity is something we got to watch out for. Global liquidity, right now, that put to call ratio is peaking out, and if it does turn back up, we might be in trouble. But in the immediate short term, the put to call ratio is showing us that we're near the end of the sell-off, right? And we can see that in the SPY. We can see that in the Qs. I'm going to go to the 30-day chart quickly. Okay. Yeah, and you can see the reversal here also. You can see the reverse head and shoulders, which it's only been a couple days, but this is a nice bottoming pattern, right? This was the level 436 that we had dropped in pre-market. We got it back above it, and then today we found support at that level, and we actually got above the top side, right? We got above the top side. So this looks like a real meaningful reversal for the S&P. I think S&P is headed for 448 at this point. Maybe by the end of the week, it gets all the way up to 448. We're going to hear it's a bull trap. It's a bull trap. And maybe it is a bull trap. Maybe it is. That's why we're keeping track of the macro headwinds and the macro forces, right? The dollar, bond yields, those are very important to take a look at as we go higher here. So Powell's meeting is going to be important. And GDP, GDP is going up. Retail sales are pointed up. I think we're in good shape here. What do I think of semis? I think semis are almost ready. We got to wait for NVIDIA earnings, but semis look pretty solid. SMH, if I were to look at semis, I would look at SMH, and SMH has a lot of strength over the past couple of days. It really is from NVIDIA. It really is coming from NVIDIA. So here's SMH. A lot of that strength is coming from NVIDIA for sure. But you can see that there's some buyers stepping in here for sure. There are some buyers stepping into SMH. Two, a lot of the fiscal policy, right? So I'm going to hit you with the outlook. I'm going to hit you with the outlook real quick. And that outlook going forward is the biggest risk to the market is still inflation, right? Moving higher, but it's not actually the risk right now because inflation is actually moving lower. Yes, the last print, the last headline print did move up for the first time in 12 months, which is really more of a testament to how the rate hikes are actually working, or a testament to inflation is coming down, right? On the headline basis, not on any individual item, but on a headline basis. Okay. Number two, most of that move up came from oil prices. Well, oil prices today are moving sideways. Maybe gasoline is up, but oil prices are moving sideways. So that's not really a big threat. Okay. So that's what the inflation outlook looks like. Next, the economy is starting to rebound. The economy is looking strong. We saw GDP forecasts, Atlanta GDP, are going higher. China is weak, but I expect China to keep cutting rates, or their Fed balance sheet money supply starts to turn back up a little bit at the risk of devaluing their currency. If they devalue their currency, then, they might be in bigger trouble. So I don't know. Maybe they do. Maybe they don't devalue their currency. Maybe they just cut rates and they don't actually print. Debasement definitely is going to devalue your currency. So they might just cut rates. And they can keep doing this because they have no inflation. They have virtually no inflation. Who does that help? Amazon, Google, Apple. because they are multinational companies, which is why I think the tech trade comes back, the big mega cap trade comes back. It did just sell off tremendously. Now you have, Tesla starting to bounce here, and you have Nvidia really bouncing, and you have Apple starting to turn up a little bit because, the end of the rate hiking cycle. Plus, those rate hikes, right? The elevated rates at 5.5% are also yielding more cash to cash holders, who could be reinvesting those earnings, or maybe they're just buying in the economy. Who knows? But yeah, this is Tesla. I want to check out Tesla's intraday, right? Now, the other part too is fiscal policy, the Inflation Reduction Act, the Infrastructure Bill, the CHIPS Act. These are all policies that I believe the White House, well, not policies that I believe, these policies are still coming into play as we speak. And I think the White House is going to have more fuel for the fire. So let's say 30-year rates go up, mortgage demand falls. Let's say, risk assets fall apart a little bit. Let's say there's some regional banking issues in the pipeline. Well, the next thing you want to look at is, if we do get if those banking issues do happen, how is the White House going to respond? With another stimulus, right? Another fiscal stimulus. If the Fed doesn't want to do it, the Fed holds rates higher, another stimulus. That's also a possibility, right? It's kind of the same story. So right now, I think the technicals are the most important aspect to the market, is watching the technicals, because we kind of know where the data is trending. We know growth is starting to turn up in the US. There we go. ZM up 7.7. Okay, so ZM, that's another thing we trade. ZM with the earnings call. Nice. I'm going to have to look this up. This is one of our trades. Let's see what they're saying here. Zoom video sees adjusted earnings. Oh, I got to, here, I'm going to see if, let's see. I'm sure this came out on CNBC. I'm going to interrupt this program so that we can listen to the Zoom earnings. Yeah, on CNBC. They should be coming out. If they didn't, I'll rewind it. I bet you they're out right now. Yep, they are out. So we're going to listen to Zoom earnings. Okay. Let's rewind it a little bit. Try to find it. Okay, cool. Yeah, there we go. So we're going to get the Zoom earnings right here. I'm going to throw that up on YouTube if you're on YouTube. If we've been looking at Zoom. I think Zoom, hopefully it doesn't sell off, but yeah, we're long Zoom. We've been talking about Zoom, Tesla, who else are we long? Teladoc sold off, but Zoom is coming into that resistance level, and we're going to listen to their earnings here. I think they're going to talk about AI in their earnings call. It's one of the last companies to actually report, but we are going to switch over here to hear what Zoom has to say. Okay, let's get the Zoom earnings on. Okay. Here we go. There we go. All right, let's see what's going on with Zoom.
Some better earnings growth behind what they've done.
I want to mention here, we've been awaiting Zoom earnings. They are out. That stock looks to me like it's popping about more than 7%. We're going through those numbers. We'll bring them to you as soon as we have clarity on them. Katie, where, if at all, does China fit into this puzzle for you? A little bit of a hike here on the rate. They need some growth. There are concerns about whether global markets get dragged down if China worsens. How does that factor into your outlook and how you're investing right now?
Well, I think the challenge has been you've seen such a divergence. I mean, the U.S. is looking very strong, while China has definitely been disappointing recently. We've seen that particularly in the oil market, the currency on there.
I mean, Greater China is an important market for them. We've seen the luxury market in China hold up better than the...
We've seen that negative or disappointment in Q2 Equities as well.
There we go.
All right. Katie, Ed, thank you. Now, as I mentioned, we got those Zoom numbers ready. Pippa Stevens has them. Pippa?
Hey, John, the stock is jumping here after the company beat on the top and the bottom line for Q2. EPS coming in at 134 per share on an adjusted basis. That was 29 cents ahead of estimates. Revenue at 1.14 billion, slightly ahead of the 1.12 billion forecast. Now, in terms of guidance, the company sees EPS for Q3 and the full year ahead of expectations, with revenue for Q3 in line with analyst estimates. Now, the company did say that its enterprise revenue was up 10.2% year over year, and that its operating cash flow grew 30.6% year over year. That stock up 6% now. John?
All right. Pippa Stevens, thank you. Let's get some instant analysis with CFRA analyst Keith Snyder. Keith, it appears to be...
Well, that's good. You got a beat on top line, beat on bottom line. You got guidance going up. You got free cash flow up 30% year over year. That sounds like a good beat for a stock that was beaten down and had very low expectations. Not low expectations, but that just got beaten down. So we're along Zoom 2025 calls, like really far out, because I think the stock can jump back to the 300s if we get policy reverse in 2024. I think the bull... there won't be any bears in the mid 2024 because interest rates will get cut. GDP will come back up. Inflation will be pretty much dead if it depends on what you believe there. And, communication services are a very important part of the evolving economy, from energy usage. So I do think Zoom has a lot of upside and, this is the first time that they've done a really good job on earnings and the stock actually moved up. Usually they've been selling off. So let's go Zoom.
Really, the cost consciousness that's benefiting this stock as much as anything. Big beat on EPS. Revenues a little better than in line. Maybe enterprise doing well, which is what you want to see, their core business. Why is it up?
Yeah, I mean, that EPS number is fantastic. The revenue, obviously, a little bit of a beat. But, cost cutting has been a huge initiative for them for the past few quarters, especially as growth has really slowed following, that huge jump we saw during the pandemic. And then with enterprise growing like it did, that's a really important future area for them. They're going up against, a lot of huge companies. You have Cisco with their WebEx platform. You have Microsoft with Teams. These platforms are ingrained in a lot of enterprises, and to be winning customers is huge for Zoom because a lot of us in the analyst community have, been looking to what's next. What does Zoom 2.0 look like, and how are they going to reignite that growth that we saw, during the years of the pandemic? And so to see them grow and beat top and bottom like this is certainly, a positive step forward for the company as a whole.
So what do they got to do here? Do they need to do M&A? I think Ring Central just bought Hopin, or at least most of its assets, a couple weeks ago. That's moving them more into, events and webinars and streaming meetings. Zoom has tried to do some acquisitions in the past, Five9 most notably. They weren't able to do that. Do they need to do something smaller? Does this perhaps, these results give them the sort of credibility with shareholders that they need in order to get something like that done?
Yeah, I mean,
All right, we don't need to hear all that. EPS beat to see if there's anything new. Yeah. I'll probably be listening to the earnings call a little later to see how that plays out. So, but you know what? Zoom, going back to the technical, Zoom is still not above. So I'm going to go back to the macro technical. It's still not above the big 74 resistance level. Oh, I was looking at crypto. Right. So we still need to go get above that level. Let's go to Zoom. Oh, you know what? There's some of these too. Here it is. So Zoom's still struggling to get, and then look at the RSI, has a little bit room to run, but Zoom needs to get above. Is it rainy outside? I'm in Phoenix, and I think that that hurricane is starting to leak over here. Let me see. Yep, looks like the hurricane is not here in Phoenix, but the weather's starting to pour over. So Zoom is still finding right now in after hours. It's at 74. Right, so we did get a big jump. Oops, let me not use that. We did just get a big jump. Let me take the RSI off. 274-ish. Right, so we're coming right back into this yellow line. But that's a lot of, oh, no, we're higher than that. My bad. We're here, right? So we just had a big jump, huge jump for Zoom. But overall, on a technical basis, no wonder we're on the freaking 30-minute chart. On a technical basis, though, we're still at resistance. So something's going to need to take Zoom above 75 to get the to really get the momentum going. We need to get above 75. So we're right into that level. I'm optimistic that the initial push was higher. I think it's going to take an earnings report and Wall Street to actually digest that going forward. Let's see, where's ARK at? ARK pulling back into the trend. Yeah, see, ARK is also at the trend. That's good news. What else did we miss? I know a lot of people like SoFi. SoFi kind of looks weird. Palantir looks a little weird. Pulling into that zone. MicroStrategy as a Bitcoin ETF is pulling back into the trend. So if there was a time to get long MicroStrategy, it is now 329, and that thing skyrocketed, especially with the short float on it. All right, that looks like, yeah, that's about it. That's what we're looking at here. So anyways, yeah, Jackson Hole is on Friday. What economic data do we got going forward? I know that was like a little interruption. I just saw Zoom earnings were coming in, and I wanted to go over that really quick. Top and bottom line beat. That's one of my favorite trades, macro trades over the next 12 months. I think is going to be Zoom. So keep your eye on Zoom. Roku is also looking pretty good, but I like the Zoom fundamentals, especially if they talk about AI on the earnings call. All right. So looking at the macro, we have a lot of economic activity data this week, right? Fed, manufacturing, existing home sales, nothing too crazy. We have some Fed speaking. Those are going to be more important to the market. The Fed speaking tomorrow, the Fed speaking Wednesday, as they speak on Wednesday. We get S&P global PMIs because if the PMI recovers, we're getting a very strong economy. We're getting new home sales on Wednesday. Thursday, we have durable good orders, more activity in the, more internal activity for the overall economy in the U.S. Initial jobless claims, Chicago Fed National Activity Index. I think these are all starting to recover. We've been talking about this for a while. Okay, I think we're going to start to see this recovery, and in the economy, anyways. And that's all going to be a testament to higher earnings, which is going to fuel markets. So even if we consolidate all the way through, let's say, all the way through September, right? October, November, December, you're consolidating into the next earnings run up, which is gonna look into this month's, the third quarter. Excuse me. That's probably what it is. All that rain. Anyways, that's what we're looking at. We're looking at earnings come up. Now, Friday is going to be big. Like I said, Michigan inflation expectations. We're looking for China, more policy commentary on China to see if they're going to cut rates also. Okay, anything on Twitter that's important on Twitter? Oh, well, I guess it's X, right? I don't know. Anyways, stay up to date. I'm going to send out probably a report today to talk about what are another macro report. Not my report from the end of the week, but just sort of what is Wall Street talking about? What are they concerned with? And you guys already know if you listen what my thoughts are on this market regime. So again, going back to it, the biggest risks right now are that the dollar does break out. It is the biggest macro force. It cannot break out if we're going to sustain this bull market. If it's going to find a bottom, we need the dollar to peak at this level, right? We need it to peak at this level and to come back down. And thank God, because we are getting the RSI, because I know a lot of people are fully in the market, right? And they're biased and they're going to be hurt. But we've had this signal before and it always falls. The only way it doesn't fall is if, you get short-term rates and long-term rates all moving up in unison. Then, the dollar will probably continue higher, and that's not going to be good. So let's see what the Fed says tomorrow. The bond market usually responds to some of the Fed speak. And these 30-year yields are breaking out. There goes risk assets. There goes the tailwind. It becomes a headwind for risk assets, and also for for mortgages, right? But the other key too here is, yes, mortgage rates are extremely high, and I think this was in one of my newsletters back. I don't know if it was a week ago. Let me see if I can find it. and it's basically showing the supply of housing, right? Housing supply, it might be here. There's a lot of housing supply coming down. Not housing supply. There's a lot of housing bill. Oh, here it is. Yeah, here it is. This is what I want to show. So the cost to buy a home is so elevated, right? The highest level it's been ever on average for the US. But at the same time, rates are at 7-8%. What does that tell you? There's going to be demand shift into apartment rents, or rents in general, maybe not apartments. But we do know the supply construction builds on multifamily homes and apartments are skyrocketing. So I think what's really shifting here for the consumer is a secular shift into renting, and then letting your cash, instead of borrowing money and paying a high interest rate. Why pay a high interest rate when you can just put your cash in the bank and yield high interest while you're renting, right? While you're renting. So it does feel kind of weird. It's like, well, I don't own if I rent. I don't own if I rent. But for the first 10 years on a house, you're paying interest for most people, right? Some people pay it all off, but you probably have money. So I'm talking about in general. So I think there's going to be a shift to rents. They're going to get cheaper as more supply comes online. And, and if interest rates do remain pretty high from the Fed, then you're going to get more yielding debt on those rates. So I think this market is still strong. There's pockets of strength. There's pockets of weakness. And we should continue to grind higher, looking out for that Tesla trade, right? Looking out for that put to call ratio to peak out, looking out for the VIX to stay below that level, and the S&P really find its legs. And again, if we stay, I think we're going to all-time highs this year. Been saying it all year. Market to all-time highs, and if that's going to happen, we need oil to stay below the 83.50 level, because inflation expectations come down, so do bond yield risks, so do risks for interest rates, and the market can find stability knowing that inflation is coming lower, especially since shelter inflation is coming lower. That's all I have for you guys today. I appreciate you staying and watching. You guys check out the newsletter. If you're not subscribed, it's free. And, just read what we put out on last Friday, see if it works out for you. I think this market is going to reverse. I think we are going to bounce here, and we're going to keep track of that. I will be back on tomorrow to go over the technicals to see if any new charts, if there's any new macro data, if there's any new positioning, sentiment charts, anything that's new, send them to me. Email them to me. Send them to me so we can evaluate it, right? A lot of bears, a lot of bulls out there. Who's right, who knows? But let's track it so you have the best decisions to make going forward. Take care of your health, okay? Markets are not everything. Take care of your health, your relationships. Make sure you guys get enough sleep. Eat a healthy diet. Stay fit. Get your exercise today. I'm going to go back to the gym. I haven't been to the gym for like 3 or 4 days. I'm dying. I need to get back that workout. Got back today. And anyways, you guys stay blessed. Appreciate you guys. Stay blessed, and I'll catch you tomorrow around the same time. Peace.